Oh, I think that would be at 4,000 at that point. Other things being equal.
Yeah.
But
No.
but the interesting thing is, it's not only, you're absolutely right, of course, but the dollar is the main short-term or near-term factor that tells you what the gold price is, obviously, the gold price in dollars, obviously. But it's not the only driver we've seen over the last year by any means, and we've had many periods when the dollar's up and gold is up as well. But clearly, if we see the Dixie down to 90, or I think it's going lower than that, gold will move up. Gold will respond meaningfully.
Commodity analysts who make long-term forecasts believe that the price of gold will generally keep rising in the next few decades as the demand for the precious metal increases. Central banks globally have been rebalancing their reserve portfolios. The US dollar's share in global foreign exchange reserves has fallen from more than 70% in 2000 to below 60% in 2025. At the same time, central banks have increased their purchases of gold, signaling a deliberate shift toward hard assets and away from dollar-denominated holdings. Renowned financial analyst AdrianDay acknowledges that gold's rise is rather the dollar's decline in purchasing power. He stated that if the dollar index drops to 90, gold could hit $4,000 in future. From a technical perspective, Adrian states that while conflicts in Ukraine and the Middle East support gold prices, they are not key drivers. Instead, he pointed to the ongoing decline in global central bank dollar reserves, now at 58%, driven by concerns over U.S. fiscal issues and dollar weaponization. Since the start of the year, the dollar index has weakened by over 8%. Despite acknowledging short-term risks, Adrian expresses 99.5% confidence that gold will end the year higher, citing a looming U.S. funding crisis as the primary driver. With foreign buyers retreating, hedge funds have stepped in to fill the gap. Day believes the Fed will resume QE as QT is nearly over. America's debt is expected to grow twice as fast as the U.S. economy over the next 30 years, according to the Government Accountability Office. Gold thrives on risk and volatility, so sharing insights into the current discourse on unsustainable debt, market overvaluation, political polarization, and de-dollarization is also paramount. Concurrently, Adrian expressed optimism about gold mining stocks, citing strong year-to-date gains in GDX and GDXJ. As economic conditions weaken, he expects increased investor interest in undervalued gold and commodity stocks. Before we dive into AdrianDay's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the markets.
I don't think I've got to choose my words carefully, because I don't think the situation in Ukraine or in the Middle East is a huge driver in gold, frankly. And so it's obviously a positive for gold as opposed to a negative for gold, but I don't think it's a huge driver. And so reversing those two situations, which I think we all hope and pray will happen, I don't think that will be devastating for gold. It might be, peace in Ukraine, for example, might be the trigger that causes an otherwise overvalued gold market to correct. But I don't think in and of itself it's a meaningful factor in driving the gold price. Again, if you look at central banks, for example, if you go back to the beginning of this century, global central banks had about 75% of their foreign reserves in the US dollar. And that's slowly come down over the last quarter century. 5 years ago, I think it was at around 65, 68%. It's now at 58%, last numbers I saw. So the trend has continued and accelerated. How long will that trend continue for? I don't know. Maybe just when they get to 50%, that will be enough. But if you're concerned about the US fiscal situation and you're concerned about dollar weaponization, I would have thought you want to just continue reducing that allocation to the dollar. So the urgency is less today than it was 3 years ago, and at 50%, the urgency will be less. But I think that trend is just going to continue, frankly, I mean, nothing that's happened in the US this year would make foreign central banks say, we don't need to get out of the dollar anymore. Everything's fine. I think in the near term, the most likely thing that will cause gold to decline, and by near term, I mean the next 3-6 months, the thing that will cause gold to decline meaningfully over an extended period will be a confluence of several factors. Ukraine war ends, Middle East war or Gaza war ends, probably because there's no more Gaza, but the Gaza war ends, a China deal, and then a series of trade deals with EU and other places. Just a confluence of factors that makes people feel they don't really need gold anymore. That's the most likely thing. But on the opposite side of that, just a continuation of what we've seen certainly will continue to drive gold. And the thing we haven't talked about yet, which is the most important thing coming up over the next 6 months, is the looming funding crisis for the federal government, the US federal government. Because that's something that's known about. It's been known about for a while. But this year, the US federal government has issued no new debt. The only debt issuance we've had this year, all year so far, is matching the maturities, the debt that's rolled off. So they haven't increased at all this year, which is really astonishing. And the longer that goes on, of course, that's why Trump is so desperate to get the debt ceiling raised. That's a different issue, but he's so desperate to get the debt ceiling raised so that they can actually issue new bonds, increase the amount of bonds issued. Because the longer it goes on, then of course the more has to be issued in a shorter period of time, which makes a successful sale or auction even less likely than if you can spread it over a whole year. And so it looks like a lot of the extraordinary measures that the government is taking, and there's been several of them. Even the deal with Wells Fargo Bank saying all your sins from 2008 are forgiven. I have to believe that part of that deal was, would you mind buying a few more treasuries for us? And that's on the small end, that's 50 billion or something. But all of the tricks and all of the tricks and techniques that every government uses, but they're all running out. And the government Besant has said, analysts have said that basically by the end of summer, the Fed will be the Treasury will be in a situation without the debt ceiling being raised, where the US starts to run out of money. The debt ceiling will probably be raised. That's a whole different issue. We don't want to, that's a whole different issue. But even once they raise the debt ceiling, then the issue is who's going to buy the bonds at what price? I don't know about you, but I wouldn't lend the US government money 30 years at 4%, would you? A lot of people look at me like I'm crazy, but when you think about what has happened over the last 3 years, who's been buying and why they've been buying, these are not the normal traditional economic factors that are driving buying of gold and gold stocks. And we've talked about who's been buying and why they've been buying. But, you've got a reasonably strong, the narrative, let's not get into whether it's true or not, but the narrative has been that the US has a strong economy, has high interest rates, has low inflation, and has a reasonably strong dollar, has had. Well, in that environment, that is precisely the wrong environment to be investing in gold. And so and that's why North American investors have typically not been in gold or gold stocks. And it wasn't totally illogical because the macroeconomic environment was not the appropriate environment in which to be buying gold. As that unwinds, whether it's the economy slowing, whether it's interest rates coming down, whether it's inflation going up or a weaker dollar. But as that environment changes, then you start to get more interest from North American investors moving into gold. And of course, the added factor when you come to gold, to the gold stocks, is that if every single month when you open your monthly statement, and this is true in Canada as well as in the US, and every month, pretty much your statement has been going up in value, you don't have much of an incentive to look elsewhere. So we saw a little bit of that at the beginning of the year, as I mentioned, when we saw inflows into European ETFs. But every month, your statement, your value's going up, you don't look elsewhere. So when the economic factors change and when the market starts to stumble, then I think people are going to start looking at other areas that have lagged. And one of those areas that has lagged, obviously, we've talked about European stocks, emerging market stocks.
Market expert AdrianDay notes that the U.S. is pursuing policies that weaken the dollar, some of which are intentionally aimed at boosting exports. While this may help trade balances, it deters foreign investment in U.S. bonds and stocks. A falling dollar discourages passive capital inflows. He argues the administration seems indifferent to attracting foreign investors. On the bond side, the footprint of foreigners in the U.S. Treasury market is shrinking. Data shows that they owned 31% of the $28.55 trillion outstanding Treasury debt at the end of last year. That share has been declining steadily since the global financial crisis. In 2008, the figure was approaching 60%. The share of overseas investors in the T-bill market has continued to shrink. In December, it was under 20%, near its lowest level on record, and sharply down from 50% a decade before. In the meantime, Adrian sees a delayed recession due to strong corporate balance sheets. He warns rising credit card debt and defaults signal weak consumer health. Job growth is mostly in government and part-time roles. Any U.S.-China deal would likely lift sentiment. Let's get back to the interview.
Completely, and there was a lot of thought among the Trump team when he came in that they wanted to get a recession out of the way quickly, well before the midterm elections, which is what governments often do. Remember Reagan back in 1980, famously, had a recession immediately, and the economy was able to recover before the midterms. But I think, I mean, on the part of any government, it's always a tough thing to say, well, let's engineer a recession or let's push the economy into recession as quickly as we can. That's always a difficult thing for even if it's the right thing to do. It's a difficult thing for a government to do. But I think at this point, frankly, we're 6 months in, 5 months in, but more importantly than 5 months, we've had these very, very dramatic policies from Trump. So I have to say at this point, certainly in the media and the public mind, he would own the recession at this point. Push it to the brink, but you're right. I mean, the policies that they are outlining are driving the dollar down. Some of them deliberately, and some of them that's just the effect of the policies. And for Bessent, yes, for Scott Bessent, the Treasury Secretary, to say the U.S. has a strong dollar policy. Well, all I can say is, if this is a strong dollar policy, I hate to see what a weak dollar policy looks like. And the dollar's really interesting, or the policy around dollar is really interesting, because we're, as you pointed out, some of the benefits of a lower dollar. But with all of these things, there's always winners and losers, right? There's effects that are positive and there's effects that are negative. That's true, of inflation or higher interest rates. There's people who win by higher interest rates and there's people who lose by higher interest rates. Similarly with the dollar, in trying to push the dollar down and make the trade balance look better, the trade balance, because we're not really talking about services here, where the U.S. has a huge advantage that offsets a lot of the trade deficit. But anyway, it makes the trade balance look better. But it also, I would think, makes foreigners less likely to want to buy U.S. bonds in particular, but also U.S. stocks. Now, of course, we know that if you're a foreigner looking at the US market and the dollar is weak, then you are buying US assets at a lower price. So that's a positive. But if the dollar is declining, and you think it's going to continue to decline, that is definitely a big negative for foreigners wanting to buy U.S. assets. And the U.S. has kind of, I think, this administration has kind of said to foreign investors, we don't really care if you come here or not. And I mean, sorry, passive investments, not active, foreign companies building factories here, that's all welcome. But in terms of foreigners buying US equities, buying US assets passively, the US has sort of not gone out of its way to welcome foreign investment. And that, of course, is a huge stumbling block for funding the deficit. Yeah, well, on the first one, I would say that the odds of a recession are still reasonably high. They're not 100%, but I think they're reasonably high. You probably heard that expression, there's an awful lot of ruin in a nation, meaning it takes great nations, other than a war, it takes great nations a long time to decline. And similarly, with an economy that has been incredibly strong for a long time, and money has been incredibly easy for a long time, well, then I would argue there's an awful lot of ruin in an economy. It just takes a long time for that economy to go into recession, because let's face it, most corporations on their balance sheet, and even a lot of individuals and households, but certainly most institutions and businesses have pretty strong balance sheets, because they've had plenty of opportunity to term out their debt. You look at a lot of companies I follow today, I look at the debt maturities, and I mean, an awful lot of these companies have virtually no debt coming due until 2031. And they've termed it out as well as rolled it over at lower rates. So they're in pretty good shape. And so it just takes a long time. Anyway, that was a long-winded answer. But I think if you look at things like jobs, retail, retail is supposed to be good. The US consumer continues to spend. Those are the headlines. But what about the credit card debt that is going up to record levels, and the credit card defaults that we're now seeing with credit card companies, just writing off credit card debt? So if a lot of consumer spending has been fueled by credit card debt that is not being paid off on a monthly basis, that can't continue forever. So that's not strong. If you look at the jobs market, new jobs numbers last week, people said, they're reasonably good. It was a beat anyway. That's all we seem to care about these days. Does it beat what we thought it was? Well, I can beat I can have my money management returns beat the expectations every single quarter if I just make the expectations low enough. But anyway, that's a different issue. But of course, as everybody knows, the downward revision of the previous 2 months actually exceeded the new jobs that were added in last month. So how strong is that? And then you look at all of the last 12 months, a majority, and I mean this literally, a majority of the new jobs created have been either government jobs or part-time jobs. Again, that's not a sign of a healthy economy in my view. Then you had the labor participation rate. That is the denominator for calculating unemployment. The number of people of working age who are still in the jobs market. And sometimes people get out of the jobs market because they join the military or because they go to college full time. But sometimes they get out of a jobs market because they've given up looking for a job. That's not a healthy sign when the labor participation rate goes down. And so that's why the unemployment rate stayed the same, because the denominator went down. And so you look at the headline numbers, new jobs created, up, great. Unemployment stays flat, great. But if you sort of, as it were, look under the hood, I don't think the reality is quite so strong. Long-winded answer, I'm sorry. I'll be quick on China. I mean, I think if China and the US simply come to an agreement, that will be very positive for the US, almost regardless of what the details are. I would say that China wants an agreement as much as the US does.
Investing in gold can often be a prudent choice for those seeking to diversify their portfolios, hedge against inflation, and protect their assets during economic uncertainty. Given AdrianDay's analysis, do you believe gold's continued rise is inevitable, or could a renewed confidence in the dollar and US markets reverse this trend? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.